Thank you, Pak Djohan, for your presentation. And thank you for our three panelists for the presentation and those of you who have submitted your question via the chat box. Ladies and gentlemen, before we start with the Q&A, I am pleased to inform you that we have more than 1,000 participants joining this webinar. We kindly appreciate your appreciation and interest in learning about our topic today. Now, to kickstart the Q&A, I would like to begin with asking the following questions. And these questions have been curated based on the key topics that most of you are asking. So I do have to apologize. In the interest of time, we cannot entertain all of the questions that have been submitted. And the first question or set of questions that I would like to throw to all panelists, and I would like Ralph, Simon, and then Pak Djohan to perhaps respond to this question in that order. There's a common theme from the question asked is about the uncertainties that come with COVID-19 and their impact to particularly estimation, valuation, and impairment. Now, more interestingly, I mean, how should those with 31st of March as year-end analyze and report this? I mean, most of the times we assume or we assume our discussion based on 31st of December. But there are some jurisdictions that may implement a different kind of year-end that may have to do this analysis and prepare, do the audit and prepare the reports earlier than others. So how do we in practice apply? For example, the specific questions that the panelists may touch on are, one is, how do we in practice apply NRP under such situation? How can we realistically differentiate between impairment as an impact of COVID-19 and those impairments from business as usual? And finally, in practice, what should we be focusing on as preparers and auditors? There are a lot of things that have been mentioned by the three panelists on this specific topic. But from your point of view, what should be the focus, the main focus for preparers and auditors on uncertainties and their impacts to estimation, valuation, and impairment? Ralph?
Yeah, thanks, Aucky. I guess I can give a few thoughts on that. One is, in respect in particular of 31 March year-ends, it is a very difficult position. I would say that most regulators where there are 31 March year-ends have given relief from reporting deadlines. Certainly, if I think of my colleagues in New Zealand, which is primarily a 31 March year-end jurisdiction, they've given an extra 2 months for preparers. So I think there's a lot to be said for almost a wait-and-see approach in that right now it may be too uncertain to come to conclusions, but once you have a few months of data post 31 March, things may become a lot clearer. I guess the other comments I would make is that to some extent it doesn't matter whether an impairment's occurred as a result of COVID-19 or as a result of any other factors. Ultimately, you still have to include it in your financial statements exactly the same. We generally, certainly under IFRS, we don't have extraordinary or exceptional items that you can separate. You still have to include it in the main trading results. In terms of the main things for preparers and auditors to look out for preparers, I would say, look, the impacts around impairment, asset values, and going concern are obvious. Look out for some of the things that are less obvious. For example, share option schemes. Share option schemes have a lot of particular rules around modifications and cancellations we don't normally have to look at, but that we've already seen a number of instances where that has come into play for 31 March year-ends. The other things to look out for, things like revenue recognition, where you have variable consideration, in particular clauses for liquidated damages and the like. That can actually significantly impact your revenue recognition under IFRS 15. And the last thing I'd say to look out for is, in respect of asset valuations, impairment, fair value. I would emphasize again the point about don't assume that things will get back to normal when normal means how things were before. I think that there is such a thing as the new normal. And when we look at future cash flows, projections in business, we need to have that in mind with the idea that the impacts of COVID-19 are going to go on for several years, the economic impacts. Sure, the lockdown will lift, but the economic impacts will go on for several years. In respect of auditing, I'd say that the two messages I would have was, one is I wouldn't want auditors to go down a sort of blanket approach of just sort of giving up and saying, well, we'll say there's a material uncertainty for everyone. I don't think that's right. I don't think that reflects the auditing standards. And I think certainly we have been saying that for a lot of businesses, there actually isn't a material uncertainty if they're relatively lightly affected. Equally, for businesses that are fully affected, material uncertainty might not be enough. You might need a greater impact than that on your audit opinion. The other key message I would have to auditors is, look, we're always told of the importance of professional skepticism. That actually becomes a lot more important in the current environment. Management, in some cases, may have incentives to downplay or understate the impact of COVID-19. And I would say that there's also a greater incentive in a lot of instances for fraud or misstatement. So we have to focus even more than usual on the requirements of ISA 240 and be aware that there's probably a greater incentive with people losing livelihoods and losing business. There's a greater incentive for fraud. And there's also a greater opportunity in that because the impact's so uncertain and the uncertainty is so great, fraudulent misstatement may be less apparent in financial statements because people don't know what to expect. People don't know what normal looks like, and therefore they're less likely to pick up fraud. So I would say those are the two key things for auditors to be focused on.
Okay. Yeah. Okay. Should I answer all the three different questions all together, or it one by one? I mean, because there are three sets of. I think Ralph covered all. I think. Right. Okay. All right. I'm in agreement with Ralph in terms of whether you differentiate between impairment, general impairment, or it's a COVID-19 impairment. It's very difficult for you to just ring fence and say that it's COVID-19 impairment and then other impairment, because I think it's impairment in total. So, but the methodology would be typically for you to look at what it would be your normal forecast cash flows, and then thereafter come out if there is an impairment indicator. So firstly, it needs to be triggered off. Then secondly, then you come up with the forecast based on what you would expect to be the normal, and then what would be the additional risk adjusted cash flows because of COVID-19. That could be a better way approach than trying to adjust the discount rate, because that's going to be even more judgmental. All right. So there are a lot of proponents for using the adjusted cash flow method, and then it is not just one stream of cash flows, but actually you need to consider probability of various streams of cash flows and get a weighted average result of it. So that's actually in the standard. So look at IAS 36. There is some guidance on that, and there is also a lot of materials out there in the internet available. I mean, among large firms, where there's a lot of guidance given on how to actually come out with those impairments. So there's a lot of guide there. The other area that I think, because it's an estimated, I mean, there's uncertainty there. It's a lot of judgment used. So that disclosures is what Djohan mentioned just now. It's very important, so that there's need for transparency. There's a lot of request, demand by regulators, especially in Europe, for preparers to disclose the impact of COVID-19, especially in terms of the disclosure, how they actually come out with the assessment of the financials. So that's one area. And then there was a talk about net realizable value assessment. So firstly, then it needs to look at what would be the net selling price at the date at the year end. So, and what could be indicative, could be subsequent sales, but then you have to assess whether that's something that is really arising from the position as a financial reporting date. Then looking at the sale price might less the cost to sell, and compare that with the cost. So the other aspect of write down inventories to be considered is also whether there's obsolescence, because then maybe demand, certain markets that you're selling, certain clientele that the organization, depending on who their clientele is, there needs to be assessment of whether then some portions of the inventory may be, maybe it becomes slow moving, and that there's a need for consideration of obsolescence. So, there's a lot of consideration there. The other area we talk about, I think fair value. I think I'll leave Djohan to discuss on verse 9 disclosure. How will multinational entities estimate? So there are various countries. Those countries applying IFRS, I think it should be quite consistent. I've also been trying to look to be on the radar to see what are the latest disclosures, and I think one of the recent ones is actually BMW in Germany. They have it's audited by PwC, and they came up with some disclosures, very generic disclosures, without showing the impact following the non-adjusting event disclosures. But you can see that they have a lot of disclosures in the to discuss about what is the impact they have, although there's no actually quantitative amount stated, but it does give you a little bit more idea of what happens. The other area is that not all industries and organizations are badly affected. For example, in Malaysia, Sime Darby Plantation, you have they recently released a report on 29th of April. It actually shared that they have assessed the impact of COVID-19, and they think that it has limited impact on the impact is limited on the group's business. So it's not always the case for every industry, but you need to assess it, entity specific, right? So that's another area. Last area is on auditing. Obviously now with ISA 540, it's a little more robust with the revised in the standard. Auditors, I think, are expected to engage their clients early concerning what they need to do with this new standard, because it's really quite groundbreaking in terms of the areas that you need to document and assess. So the areas of what is the method, the completeness of data, and looking at exercising professional skepticism, and looking at corroborative evidence, and also conflicting evidence in terms of the clients, looking at cash flow forecast, for example, and how you actually come up with your assumptions. So that will be definitely an increasing challenge, because as it is already a challenging standard. But now with coronavirus impact, that's going to be really, something that the auditors will need to prepare for early.
Thanks, Simon. Pak Djohan, anything to add, Pak?
Yeah, I think I would like to re-emphasize several points maybe. If you see my presentation, if you listen to my presentation, I think I mainly focus on the 31st December 2019 financial statement. If we fast forward to 31st March, especially for the entity and the auditor in Indonesia, most of them maybe need to prepare the first quarter financial statement. And then the issue, other than has been mentioned by the other panelists, I think is the tax rate, yeah. Because in the Perpu issued by our President, Pak Jokowi, on the 31st of March 2020, also anticipate different tax rate. So I think PSAK 46 or IAS 12 is applicable to assess that, and when is the tax law or tax rate is actually concluded as substantively enacted. I think the entity must make a decision and conclusion whether the issuance of the Perpu is actually constitute substantively enacted timing for the tax rate. The other, I would like to reiterate, I think most of the company in now facing the new normal, that probably their previous normal is no impairment trigger at all. So if there is no impairment trigger, then there is no impairment review for the non-financial asset.
Yeah.
But because of the COVID-19 affecting almost every industry, I'm not saying all the industry, but I think now it's become the new norm that is create an impairment trigger that maybe most of the company now need to prepare the resources to prepare the proper financial impairment review analysis for the auditor to review. One point I think to note, as also mentioned by Ralph and Simon, I think another new norm on this impairment, I think if in the past, if we do the impairment review, maybe based on one scenario only, I think the new norm, because of the uncertainty, as mentioned by Simon as well, maybe it's easier to adjust the cash flow using a multiple scenario. Yeah, multiple meaning more than one. Yeah, how it will be done in practice, I think it depends on the skill that already have by the entities and how the model is operated custom to the entity itself. The last point that I would like to mention as well, I think the NRV. The NRV, if you are selling a kind of a specific product that specific to the entity, that maybe your competitor is not selling the very identical product, it's not kind of a commodity product, then assessment whether the subsequent selling price provide an evidence exists at the balance sheet date would be very challenging on the 31st of March. Because I think, except for the several industry like health and others, then I think most of the industry will see a declining prices of their product selling after 31st of March 2020. So how you differentiate whether this is provide evidence that exists at the 31st March or is actually a declining prices after the balance sheet date, I think would be very challenging and difficult task to complete. Yeah. That's maybe my point to add. Okay.
Yes, thank you, Pak Djohan. And if I may, I would like to pick up some of the points that actually the three panelists have mentioned and ask again the three panelists this question specifically on disclosure. I mean, obviously there are multinational entities that are operating in different jurisdictions. Now, in cases where some of the countries perhaps did not state COVID-19 as force majeure, how do these entities treat this pandemic, and how do the pandemics will affect the way they report their numbers in their report, especially on their disclosure? Do you have any comments on that? Perhaps starting with Ralph?
Yeah, it's a difficult question to answer. We haven't seen that much as yet. I would say that in the Australian context, while the economic impact is severe, I don't think we're in a situation where you start sort of using force majeure or anything similar to essentially bypass any of the rules of IFRS. I still think, and the regulatory standard set has been very clear here that the requirements of IFRS and indeed of audit standards do apply in full, and they would expect to report their numbers as normal.
Simon? Okay,
I was not so clear about the question, but when I saw force majeure, the clause, basically it is unforeseen circumstances that prevent someone from fulfilling contract, and normally those clauses are there to protect those who enter into the contract. So basically, then I would say that if unusual situation happen and we say COVID-19 is that situation, so then they can actually exit the contract without the penalty. So that's another angle to it. So if that's the case, then for example, a contract that would have become onerous had they not been able, had there been no such clauses in the contract, then in this case, if they have that, then they can avoid having, making the contract onerous, because then you have to look at which is the better one. Exit. If they exit, they have minimal cost, then probably that would be the impact rather than going through the entire contract. So that's one thought about force majeure situation. But I think
yes, Simon, sorry.
Yes.
Perhaps just from the perspective of multinational entities, where perhaps they are operating in different jurisdictions.
Yeah.
Where in some jurisdiction, perhaps COVID-19 is not being treated as force majeure. How do you think these companies will treat the reports?
So, so if they think that it's a normal situation, but then you have to still assess whether there is any impairment. You know, are businesses affected by the situation, and do the necessary. If there's indicator, then they have to do the impairment test triggers, and then write down and if necessary. So that's and if it's based on different jurisdiction, then it's also you look at the jurisdiction. What are the support? What are the laws? What are the government support during for different jurisdictions, because they vary. So it needs to be accounted for based on their scenario at each jurisdiction. And when you do the consolidation, then it's consolidated at the group level. It doesn't mean that you have to make it align all to the home country's jurisdiction, but because it could be very specific to the various jurisdictions that they're operating in.
Thank you, Simon. Pak Djohan, do you have anything to add, Pak?
Yeah, I think I have a similar impression with Simon. So I'm not clear what's the relationship between the force majeure and the disclosure. Except to one thing, yeah. I think whether it's not pandemic or pandemic, even I think in the pandemic situation, the disclosure cannot be boilerplate, meaning that they cannot be copy and paste from other entities to be used in the certain territories. So I think it should be, because of the uncertainty, they should be tailored to the specific. Otherwise, the user or the reader will lose the story behind impact faced by the entities. I think that's the general comment, if I understand the question correctly. But on the other piece, actually, Ralph mentioned that the ISB doing something on the list standard. Similarly, the SAK also considered the same amendment to PSAK 73, although it's just effective by 1st January 2020. So we are going to have another session with the in the stock exchange session together to address this as a public hearing for the amendment of PSAK 733. In one of the amendment, I think, as discussed by Simon as well, is whether in the contract itself anticipate a force majeure clause. If the contract itself is anticipate a major clause, force majeure clause, then I think in the normal situation under IFRS 16, this will not consider as a list modification. Yeah. So I think the force majeure or not force majeure maybe need to be analyzed by specific standard, as mentioned by Simon as well. So whether we declare pandemic or not pandemic, I think it is not the impairment trigger. The impairment trigger is actually how is the company affected by the situation, regardless whether government declare pandemic or not pandemic. In the hypothetical countries, maybe, yeah, XYZ, the government for whatever reason does not want to and maybe have a good reason not to declare as a force majeure or pandemic situation in their countries, but the entity in that hypothetical country still need to assess whether the impairment trigger, because with the globalization like now, I think one event happen in one country, I'm sure it will be impacted to the other country, although the government does not declare, although the government in that the entity domicile does not declare as a pandemic or force majeure or whatever the legal terms for that. I think that's probably the thing that I would like to add. Okay.
Yes, thank you, Pak Djohan. That's very informative. And in the interest of time, I think we're going to focus on one last question, and this one is on audit. So the three presenters have shared some of their insight on audit issues, but one of the questions asked actually by a couple of our participants is on audit of a government institution, so public sector audit. So in short, if I would like to ask Ralph, Simon, and then Pak Djohan, is there any specific issues that you see in terms of audit of government institution or public sector audits because of this caused by this pandemic. Ralph?
I'm afraid I'm going to have to give the good old answer of it depends here. Look, clearly governments are less affected than others by coronavirus, perhaps usually less affected than the private sector businesses. But there are probably still for many government entities going to be significant issues around asset valuations. I've already been in discussions with a couple of the state governments here in Australia around the basis on which public sector assets can or should be valued. And again, it's really a case assessment of whether depreciated replacement cost is the appropriate basis for valuation, which it is for some public sector assets, or whether they should consider fair value, in other words, disposal proceeds, in which case there is likely to be a significant impact.
Simon?
And I think I'm agreeable that general, perhaps they may not be so significantly affected, but you need also to look at the nature of the operation. Some of them may have revenue streams, which there could be some impact there. Then in terms of asset valuation, it's the same principle. I think if you apply the public sector standards, IPSAS, which is quite aligned with IFRS, similar in principles. So I think there would be also considerations for impairment and all that. So I would not think that it would be less challenging than looking at the commercial sector. But the other area in terms of public sector, in terms of disclosure, because there is also a public interest perspective. So I think, definitely better, more transparency in terms of disclosures would be much welcome, because there is also a public interest perspective in looking at what the government is actually doing in addressing the COVID-19 pandemic. So looking at also from the stakeholder perspective, perhaps I would be more interested to look at the disclosures, especially those government sectors that actually apply certain principles of integrated reporting, for example, and how they actually create value, even in such a time as this, how they actually work towards addressing this issue. So that would be something I would also look forward to in terms of looking at public sector disclosures. And auditors would also need to look at that, this kind of disclosures are consistent with what they do in their audit work.
Lastly, Pak Djohan.
To add on Indonesian specific, I think if the question relating to the public sector in Indonesia, I would like to define the question as what I mentioned now. So if the public sector covering the state-owned enterprise, then I think the state-owned enterprise is also need to comply with the SAK, the normal financial accounting standard. So that's why in Indonesia, I think the public sector is only limited to the central government and regional government. If that's what is meant by the person who raised this question, then I think in Indonesian context, our standard akuntansi pemerintahan or the government accounting standard is not yet aligned with our SAK and also not yet aligned with IPSAS. So they have their own rule, which is, I think, if the person raised this question is really targeting to that, I think they have to look at to the what is regulated or prescribed by the standard akuntansi pemerintahan. Other than that, if the government-related entity have to apply the SAK, then I think whatever we have discussed until now, it is relevant for them. It is relevant for them. I think that's the thing that I would like to add, Mas Aucky.
Yeah, to all the panelists. Now it's 5 p.m. in Jakarta, Indonesia, ladies and gentlemen. So it is certainly great to see the positive responses and your active participation in this webinar. And for those of you who are interested to learn more about the impact of COVID-19, I invite you to visit ICAEW, IAI, and AFA websites to access more updates and resources on the topic. Dan Bapak Ibu, kami juga mengundang Bapak Ibu untuk mengisi survei singkat yang sudah kami berikan linknya, tautannya di chat box. Terima kasih untuk Bapak Ibu juga yang sudah berpartisipasi untuk mengisi survei tersebut. Masukan Bapak Ibu sangat kami hargai. Ladies and gentlemen, on behalf of our host, again, ICAEW, IAI, and AFA, I would like to first thank our 3 panelists for today's webinar. And also, I would like to thank all of you, all participants, for joining us in this our series for 2020. Now, please take care, stay safe, and see you at our next joint webinar. Thank you.
Thank you. Bye-bye.
Thank you, everyone.